I was not going to make another video on covered calls, but I was at a retail investor conference recently. That's me and the plain bagel up on stage, and I spent the day talking to retail investors. It struck me how hard the conference attendees were being sold on covered call funds and how frequently I was being asked about them. When I made my last video on this topic, I honestly did not realize how widespread this financial bullshit had become. These products are likely to be detrimental to long-term investors, including those who need income, and I think it's important for the truth about what they should be expected to do to be articulated in an understandable way. I'm Ben Felix, Chief Investment Officer at PWL Capital, and I'm going to tell you again why the passive income from covered calls is financial bullshit. I'm going to start with some quick background on covered calls, go through some live fund examples with reasonably long-term data, including dividend reinvestment, and then go through similar examples modeling spending from the portfolios. As you will see, even in that case, covered calls perform worse than their underlying equities. If you stick around to the end of the video, I also have some comments on whether I, as a chief investment officer and portfolio manager, am professionally threatened by covered calls, and also why people need to be aware of incentives when they are consuming information. Covered calls are a perfect storm of financial innovation, which tends to favor the financial product provider more than the end consumer, and investor biases, which lead people to seek income-producing investments without realizing the cost to total returns. Selling a call option means selling someone the right to buy a stock from you at a predetermined price called the strike price in exchange for a premium. Say the stock is trading at $100, you sell a call option with a strike price of $105 and you collect a $2 premium. The effect of this trade will depend on the future price of the stock. If the stock stays below $105, the option expires worthless. You keep the $2 premium, which means in this whole light green shaded range in the chart, you're always doing a little bit better than if you had just held the stock. As long as the stock stays above $98, you're not losing any money on the trade. If the stock rises above $105, the option gets exercised. Your upside is capped. You do make $5 from the stock price increase, plus the $2 premium from selling the option. That's a maximum profit of $7 on the trade. If the price goes higher than that, you don't participate in the upside. The line on the payoff diagram flattens right there. Compared to simply holding the stock, you're ahead as long as the price stays below $107. That's the strike price plus the premium. But once it climbs past $107, you would have been better off without the covered call. And on the downside, say the stock crashes to $50, you still pocket the $2 premium, but you're taking nearly the full hit on the price decline of the shares. The premium softens the blow a little tiny bit on the downside, but your downside risk is mostly unchanged from simply owning the stock. A fund using this strategy typically distributes the option premiums from selling calls to investors, resulting in their high distribution yields. Those distribution yields are misleading due to their effect on total returns. Remember, selling the call is only the first step in the trade. The fund has sold the right to buy the underlying stock at the strike price. If the price of the underlying rises above the strike price, the option holder, whoever the fund sold the option to, will exercise their call option, and the fund will have to sell their stock at a price below its market value, putting a cap on upside returns. The result is that selling the call has reduced exposure to the underlying equity primarily on the upside, while downside returns remained largely exposed, reducing expected returns and capping the ability of the fund to recover after the inevitable downturns that stocks experience. For long-term investors, my view is that covered call funds are not good investments. They do not generate passive income, and they create unnecessary layers of risk and cost. This is also true for investors who need income, as I will show you with 5 examples in just a minute. These funds create the illusion of income while systematically lowering expected returns and increasing risk by changing the shape of the distribution of returns. One of the most common questions that I got in my last video was whether my performance comparisons assumed the reinvestment of distributions. The yields on these covered call funds are incredibly high, so distributions being reinvested or not does matter a lot. I can confirm that my performance comparisons did assume reinvestment of distributions, and they will in this video too. Let's look at some quick examples. The Global X S&P 500 covered call ETF has trailed the iShares Core S&P 500 ETF by an annualized 3.15 percentage points since January 2014. The Global X S&P TSX 60 covered call ETF has trailed the iShares S&P TSX 60 ETF by 3.81 percentage points since March 2011. And the BMO Covered Call Canadian Banks ETF has trailed the BMO Equal Weight Banks ETF by an annualized 2.86 percentage points since February 2011. An important question is whether total returns, which we just looked at, are the right metric for an income-oriented investor. The premise here is that showing wealth accumulation and annualized returns, as I just did, might itself be misleading if covered calls actually perform better in a scenario where funds from the portfolio are needed each month to buy your groceries and pay your property taxes or rent or whatever. I'm going to address this with a simple portfolio withdrawal analysis. I have 10 years of data for 5 pairs of funds. Each pair has a covered call fund and a fund of the underlying equity, or a very close proxy for the underlying equity. In my model, the investor in the covered call fund is spending approximately the fund's distributions, while the investor in the underlying equities will spend the same dollar amount as the covered call investor each month through a combination of portfolio dividends and selling shares. I'll say it again since this is really important to the example. They are both spending the exact same dollar amount each month, but the investor in the regular equity fund in the underlying equities is creating their own income through a combination of dividends and sales from the portfolio. Believe it or not, whether your returns come from income or capital, it is the combination of the two, the total return, that actually matters for funding your consumption. And it is possible, contrary to popular belief, to spend from the capital portion of a portfolio sustainably. If you do not believe this to be true, you are suffering from the mental accounting bias, and it may be costing you a lot, as we are about to see. This withdrawal analysis will give us ending portfolio values to compare, where a higher portfolio value, remember, holding withdrawal amounts constant in dollar terms, suggests a better outcome. After running through the withdrawal scenarios, I found that not one of the covered call funds had higher ending wealth after 10 years than a comparable fund of the underlying equities. The investor in the underlying spent the same dollar amount as the covered call investor each month and had, on average, 26% more capital left after 10 years. Mind-blowing, passive investment income in shambles. I was not surprised by this, and you should not be either. Covered calls are capping upside returns without offering downside protection, and their yield is far from sufficient to offset the lost upside. The implied cost of these products is substantial. I solved for the non-tax deductible fee that you would have to pay to invest in the underlying equity funds, such that the ending wealth outcomes are equal to their covered call counterparts. The break-even fee was between 1.5 and 2.7%, depending on the fund. That's not to suggest that you should be paying a fee that high to invest. It just illustrates how much the covered call strategy is costing you relative to simply investing in the underlying equities and creating your own income stream by receiving dividends and selling some shares. The other thing I looked at is how much cash you would need to hold alongside the underlying equities in each case, such that the ending wealth for the covered calls fund and the portfolio of the underlying equities plus cash have the same ending wealth. Again, holding withdrawals constant. Remember that covered calls reduce your exposure to the underlying equities asymmetrically by capping upside while leaving downside mostly exposed. Another way to reduce your exposure to an equity is to explicitly reduce your exposure to it by selling some of your position and then holding the sale proceeds in a low-risk investment like a high-interest savings account. I found that the cash allocation, the high-interest savings account allocation that make the wealth outcomes equal range from 19% to 36%. This means that in the most extreme case in my examples, you could hold a portfolio of 36% cash and 64% stock, and holding monthly spending constant at the yield of the covered call fund have an outcome equal to writing covered calls on the same underlying equities. Again, I am not suggesting that you should be holding high cash allocations if you're living off your portfolio, but I think this is another great way to illustrate the effect that covered calls have on expected returns, including in cases where the portfolio is funding cash flow needs. It's similar to holding a whole bunch of cash, except in the case of covered calls, you're fully exposed to the downside risk of the stock. At least holding cash reduces downside risk exposure. Again, this should not be surprising. If you want income, creating it yourself through a combination of dividends and sales produces a better expected outcome than writing covered calls. Their high distribution yields create the illusion of income, but that income comes with a liability, the capped upside on returns in the event that the option is exercised. That, at least in these examples, far more than offsets the income. The other big trade-off for long-term investors is that by capping upside returns, you are removing the mean reversion that historical stock returns have exhibited. After bad returns, stock returns tends to bounce back. Those bounce backs are important to long-term returns and make stocks a bit less risky than they would be if returns were completely random. To broaden my sample, I collected data for 20 Canadian-listed covered call ETFs with closely or identically matched ETFs of the underlying holdings, and I compared their performance. To be clear, we are back to total return comparisons now, not withdrawal analysis, just because it's a short time series of data. In cases where the covered call fund is not an index fund, I found a fund with a high holdings overlap and high return correlation to compare it to for the underlying. I excluded really niche funds and those without any obvious comparables for the underlying. This speaks to another problem that I see with a lot of these products. They're often really niche sector funds, and they often hold concentrated, actively managed underlying portfolios. Those sector bets and the individual stock risk and the active management all add to the risk of these products for long-term investors. I limited my sample to funds with at least 1 year of history. I know that's still way too short to draw conclusions from, but this is what I had to work with. There's just not a lot of funds with really long histories. And the newer funds tell the exact same story as the older ones. Out of the 20 funds, only 2 have outperformed a comparable underlying equity fund. Both of them were technology-covered call funds with fairly short histories and imperfectly matched underlying equity portfolios, so I wouldn't read too much into those 2 that outperformed. On average, the covered call funds in this sample underperform comparable underlying equity funds by an annualized 3.25 percentage points, and the median underperformance is 2.96 percentage points. As we saw earlier, this underperformance matters for both accumulators and people drawing from their portfolios. The last point I'll cover is what are generally called enhanced covered call funds. These funds not only employ a covered call strategy, but also use leverage to increase their yield and their expected returns. I'll be honest, these things are fascinating pieces of financial technology. The problem, though, is that the history of financial innovation has tended to create profits for financial product manufacturers at the expense of end investors. That aside, I think you have to appreciate how incredible it is that a fairly complex portfolio like this is available under a single ticker, for better or for worse. Let's look at some enhanced covered call funds. To keep it simple, I will look at the Global X Index series of funds since they have ETFs for the underlying with covered calls, and enhanced versions for both. They are targeting a leverage ratio of 125% in their enhanced funds. Across 5 index funds, all over periods where returns have been overall positive for the underlying equities, the performance of the enhanced covered call fund is above the regular covered call funds and below the returns of the underlying equities. The leverage covered call funds have also performed worse than the others during periods of negative returns. What we will generally see is that leverage boosts returns of these portfolios when times are good and makes their drawdowns more severe when times are bad. No surprises there. Overall, though, leverage has helped all of these enhanced funds outperform their not enhanced covered call counterparts over this short period, which should be expected, again, when returns are positive. Leverage is not a bad thing, but I find the case for applying leverage to a covered call fund to be a little bit odd. Remember, covered calls are capping upside and not helping much on the downside. Leverage is enhancing both the upside and the downside. If you're comfortable with higher volatility and leverage, leveraging the underlying equity without writing calls likely makes more sense. The data support this. In all 5 of my example funds, the leverage version of the underlying has outperformed the underlying, the covered call fund, and the leveraged covered call fund. One last thing I want to address is whether I, as a financial professional, feel threatened by covered call funds, which is something that has come up a few times since I made my last video. The idea seems to be that these products are so good that they will put wealth management firms out of business entirely. They won't. Wealth management is about much more than creating an income stream in retirement. Expert financial advice can be categorized into areas where knowledge of base rates, technical competence in financial planning, and an understanding of human psychology can be applied to help people arrive at high-quality financial decisions. Those areas are goal formation and quantification, asset allocation, cash flow planning, insurance needs analysis, financial product allocation, and tax awareness. Covered calls may sort of solve cash flow planning, but that's about it. I also have some comments on where the information promoting covered calls is coming from. It is a requirement in Canada for content creators to disclose when their content is sponsored. This is intended to avoid hidden conflicts of interest. A lot of the content out there promoting covered calls as a strategy is, drumroll, sponsored by companies selling covered call ETFs. This is obviously a conflict of interest, at least it isn't hidden, but it still warrants caution. I have my own conflicts of interest. To be clear, I work for PWL Capital, which is a wealth management firm. It is good for us if people decide to delegate their portfolio management and the financial planning that informs that portfolio management to us. But we have nothing to gain or lose based on whether you invest in covered call funds. As discretionary portfolio managers, we can, and as fiduciaries, we must use covered call ETFs in our clients' portfolios if we believe that is what is in the client's best interest. We do not use them because we think they are detrimental to investors at any stage in life for the reasons I have shown in this video and in my last video. Other than the psychological pacification that may come from income distributions, these funds, in my opinion, do not have any redeeming qualities. I urge any investors who've been wooed by the promise of so-called passive income to ensure that they understand exactly what they are investing in and why those specific investment characteristics are worth the high implied costs I have detailed in this video. I also implore you to understand where you are getting your information and what the information source's incentives are. Thanks for watching. I'm Ben Felix, Chief Investment Officer at PWL Capital. If you enjoyed this video, please share with someone who is not yet aware of the high implied costs of covered calls.